But Sunil Subramaniam, MD and CEO at Sundaram Mutual Fund, joins in to talk about the market moods. Sunil, hi, morning. Good to chat with you. What is it that you're making of the markets right now? Because just about any and every headline seems to be a bad one, be it crude, be it currency, or for that matter, global news flow.
Absolutely. I think this is a very sensitive, it's like a stretched balloon. The market is like as you've seen over the last few months, it's a few selective stocks and sectors which have taken the market up. And this is essentially because of what we could call as a flight to safety. So world over and in India, there is this flight to safety which is reflecting in the currency as well as in the stock markets. So if you see there's money flowing back into advanced countries, so all emerging market currencies are under pressure, and within India, also fund managers are tending to go for visibility and earnings rather than betting on long-term, earnings recovery. So what you are seeing essentially is a dollar play by fund managers. So IT, pharma, the only domestic play which is giving some kind of support is consumption. So in this sense, I'd say this is just a market reaction. I think till November, the results in the US election and the results of the Indian state elections come through. This level of volatility and uncertainty will continue, and uncertainty will continue in the market. So I think it's a time that fund managers are playing safe. That's what I would say.
Having said that, how are you approaching the investment rationale for IT and pharma? Or do you think that's pretty much done and dusted? It's not like overnight with the currencies fall, their earnings would see a facelift. Yes, there would be some margin cushion, but in terms of the deal flow, it would not make a material impact.
No, you see, the key point is that on a day-to-day basis, we tend to react to this currency as if a weakening currency is the best for IT and pharma. But one has to be cautious here because it's the perspective of relative to other emerging markets, how the currency is moving. We always tend to react to our rupee weakening, with a shock. But if you look at, yes, over the last 1 month, maybe the rupee has been falling more than others. But over 3 months and 6 months, the rupee is actually not fallen as much as other emerging market currencies. So I think the knee-jerk reaction to currency to go to IT and pharma has to be tempered by the fact that is the rupee really, because what's happened is over a long period of time the rupee has not weakened as it should have. The normal purchasing power parity rule between the advanced countries and India should have come into play, and there should have been a 3 to 4% correction in the rupee over the last 3 to 4 years. Since it didn't happen, because FII flows were strong into our stock markets, FDI flows were coming in, it kept the rupee artificially inflated and at a high level. That is just a reaction to the normal. There's a reversion happening. I think still the rupee gets to 73 half. I don't think RBI is also worried in terms of its real effective exchange rate. So I think we should take this whole rupee thing in this proper perspective, wait to see how it performs with respect to other emerging markets. And second, you mentioned IT and pharma. Again, people are tending to react to this, but look at a pharma company or an IT company where the CFO would have hedged his bets. When it went to 71, let's say he felt, 71 is already gone, let me protect my earnings. And if he had hedged his currency, this move from 71 further weakening would have actually hurt him in terms of P&L. So let's be very cautious, let's understand. I think the golden rule is to look at individual companies, see what their hedging policy is, see how widespread their businesses are. Because again, if you have a large buyer sitting there, he is also aware that the currency is weakening. So they will try to reprice these contracts. So I think it's not right to just buy the sector because of the currency weakening. It's important to not give up on your stock-related research, look at individual companies, how they are managing this currency matter, and then take a call. That being said, I think software and consumption continue to remain our top picks in the current bid. Pharma, we are a little more cautious because while the currency is helping export-oriented pharma, as we saw in a few companies, there's still an FDA-related regulatory risk around that sector. So we're a little more cautious on pharma, but we are bullish on IT and software and domestic consumption in this space.
We understand that in this current, brittle environment, Sunil, you've also launched a new fund. Tell us more about it. Does it have IT pharma exposure largely?
Okay, what we've launched is called a services sector fund. This closes for subscription day after tomorrow, so it's still open for subscription. We're getting very good flows. We've already touched the 500 crore mark in terms of collections. So this fund is actually a balanced fund in terms of the approach. It's got, while it's a services sector, it is spread across 15 subsectors. Services is a mega sector. So it has both IT, software services, BPM services, which are going to benefit from currency depreciation. At the same time, it has domestic growth stories like consumption, like retail financing, and then what feeds off this whole this thing like transportation and logistics, staffing services, a lot of online services in it. So it's a blend of fast-growing current sectors in the Indian economy, plus those which have the potential for super growth as listing comes into the services sector. So services is about 54% of Indian GDP, but in the US, UK and advanced countries, it's at 70% of GDP. So that's a gap that still catch up for India to do. And second, while 54% of the economy is in services, only 35% of the market cap is in services. So there's a catch up between 35 to 54, which needs to happen as Indian economy goes from 54 to 70 on services. So all in all, we believe it's a very ideal kind of a fund which can be a permanent allocation in any investor's portfolio, because this is aligned closely to the India growth story. And for those who believe that when the manufacturing cycle comes, that services would wouldn't get impacted. For every one job created in the manufacturing sector, 1.8 jobs get created in related services sector. So this is something which is very tuned to the Indian growth story, and we believe it's a very, while it's called a sector fund, like I mentioned, it's a diversified across 15 subsectors and would be managed in a multi-cap portfolio, because there are 30 large cap, 40 mid cap and over 100 small cap companies in its current universe itself. So we believe it's a fund which is ideally, so that's why we've labeled the advertising campaign, if you have noticed this, as controlled aggression. The aggression comes from the super fast services growth story in India. For all the reasons I mentioned, the control comes from the spread over 15 industries and the spread over a large cap, mid cap and small cap universe. I think that's the right way to call the fund, as a controlled aggression.
Some would still argue, Sunil, that that the aggression has already been seen when it comes to these service-oriented themes, and so you'll have a problem in spotting value within the segment. How do you justify that? How do you explain your rationale on?
So this is a growth fund.
Point?
Yeah, so this is a growth fund, it's not a value fund, okay? So it's going to be tuned to Indian growth story. While I said that the current growth space like IT, retail credit and retail will be a part of this fund and will participate in the current growth. Like I mentioned, right, the value would come in when the related services pick up. So at no point is this going to be a value fund. We are not going to be we are looking for growth in this, because this is a growth oriented story. So while some of the value in sectors like IT, like you said, valuations have gone up, we do believe that this is just anticipating future growth. So we will have to take a call and see whether these valuations are justified, because I'll tell you, this sector, despite the higher valuations, has delivered. We did a service sector index where we have created a 49 sector index out of the BSE 200, which is the benchmark. And that index has delivered something like 28% per annum over the last 15 years, while the BSE 200 has delivered 15% per annum. So there's a clear 10 to 11% alpha over the BSE 200. So the point is that if India is going to grow, these growth sectors are going to grow, and services is going to be there wherever growth is there. So just looking narrowly at the current set to look at IT, retail and say this is already valued high, so future growth will not be reflected, it's not correct. I think wherever growth happens, services will benefit from that, and there are enough sectors to identify good quality wealth creation opportunities, which is what I would call growth, and not just stick only to a value concept.
Okay, Sunil, great to chat with you about the markets. For now, we're going to take a very quick break with news that there hasn't been much improvement. We're still down roughly about 1%, 11,538 for the Nifty futures. All sectors barring IT are dragging the markets lower. Quick break. When we come back, lots more lined up.